Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Luyuan Group Holding, Cayman Limited Annual Report. Luyuan Group Holding, Cayman Limited is a company that specializes in the development, manufacture, and sale of electric vehicles and related accessories in mainland China. The company's product line includes various types of electric two-wheeled vehicles such as e-scooters, e-bicycles, e-motorbikes, and e-kick scooters, all bearing the Luyuan brand. In addition to its vehicle offerings, the company also provides a range of accessories for its products. Founded in 2003 and headquartered in Jinhua, China, Luyuan Group Holding, Cayman Limited has established itself as a key player in the electric vehicle market in mainland China. Luyuan Group Holding, Cayman Limited market capitalization of $5 billion is materially smaller than most of its industry peers of roughly $144 billion. Luyuan Group Holding, Cayman Limited trades at a higher price-to-earnings ratio of 27 times and a higher price-to-book ratio of 2.91 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 65% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for the company can be attributed to several key factors. Firstly, sales of goods increased by 17.3% from 2024 to 2025, with a significant contribution coming from electric bicycles and their parts. The company's improved channel efficiency and product diversification in these areas have been major contributors to this growth. Additionally, the rapid expansion of e-commerce has also played a crucial role, as well as the strong demand for electric two-wheelers due to their flexibility and efficiency. Furthermore, ongoing urbanization has increased the need for last-mile transportation solutions, which the company's products are well-positioned to meet. Government policies promoting shared mobility as a sustainable solution have also contributed to the growth in demand for electric two-wheelers. The company's expansion into new international markets, launch of innovative products targeting overseas needs, and introduction of a service-plus subscription business model have all helped to drive revenue growth. In contrast, the primary drivers of revenue decline are more limited. A decrease in revenue from services by 6.1% from 2024 to 2025 is the most significant contributor to this trend. Additionally, structural changes related to market demand for electric scooters and slight decreases in revenue from batteries and other products have also contributed to the decline in revenue. The financial health of a company can be gauged through its ability to generate positive operating cash flow. However, based on the provided information, it appears that this company is struggling with negative operating cash flow. This is evident from the data presented on page 33, which suggests a decline in the company's overall cash and cash equivalents. The presence of negative operating cash flow indicates that the company is not generating sufficient funds to cover its operational expenses. As a result, it may be facing financial difficulties and struggling to maintain a stable cash position. This can have significant implications for the company's long-term viability and ability to invest in growth initiatives. The company has experienced a significant increase in its debt level over the past year. The total debt has risen by RMB 589,042 from RMB 2,826,611 in 2024 to RMB 3,415,653 in 2025. This is reflected in various categories of debt, including time deposits, non-current liabilities, current liabilities, and borrowings. Specifically, the total borrowings have increased by 28% or RMB 284,095 from 2024 to 2025. The company has also pledged more assets as security for its financial instruments, with an increase in pledged assets of RMB 41.7 million and financial instruments pledged as security of RMB 294.2 million. These changes indicate a substantial rise in the company's debt level over the past year. In the recent analysis of regional and segmental performance, some areas have stood out as notable successes. The southwestern China city has demonstrated exceptional growth, showcasing its potential for future development. Additionally, smart manufacturing factories have also shown impressive results, highlighting the benefits of adopting cutting-edge technology in production processes. On the other hand, certain regions and segments have struggled to keep pace with their peers. The Shandong plant and Guangxi plant have both underperformed, indicating areas where improvement is needed. These plants will require targeted support and investment to get back on track and meet expected standards. Management's outlook on the company's strategy is centered around several key initiatives. Firstly, they aim to enhance manufacturing capabilities through standardization, automation, and intelligence by launching smart production bases, optimizing production systems, and promoting collaboration in product development chains. In addition to this, the company plans to expand internationally by focusing on localized brand penetration and digital marketing. This includes introducing new products and business models to drive growth and enhancing customer stickiness through a service plus subscription model. Management is also committed to adopting a stable and prudent funding policy to optimize the financial position and mitigate financial risks. Furthermore, they will continue to identify new opportunities for business development, ensuring that the company remains competitive in its market. Overall, management's strategy emphasizes innovation, expansion, and risk mitigation, positioning the company for long-term growth and success. There is no significant activity to report on acquisitions and divestitures for this period. The company has not made any notable purchases or sales of assets, subsidiaries, or businesses that would impact its operations or financials. As a result, there are no major changes in the company's portfolio or structure. The company's dividend payment history reveals a consistent trend of rewarding its shareholders with regular payouts. In 2024, the company distributed HKD 15 cents per share to its investors, marking the first instance of dividend payment. The following year, 2025, saw an identical payout of HKD 0.15 per share, indicating a commitment to maintaining a stable and predictable dividend policy. Concerns have been raised regarding inventory buildup within a company's operations. The data suggests that there has been an increase in raw materials and consumables used, with a notable rise from $679,815 to an unspecified amount. Furthermore, finished goods inventory has seen a significant surge, increasing by 36% from 196,611 units in 2024 to 267,448 units in 2025. This buildup is also reflected in the overall inventory levels, which have increased by 10.3%. The primary drivers of this increase are raw materials and goods in transit. While these figures indicate a potential issue with inventory management, there is no indication of supply chain disruption within the provided data. That concludes the financial summary for Luyuan Group Holding, Cayman Limited. Feel free to comment below, and I will be happy to answer them when possible.